Have you ever wondered why casinos are some of the most consistently profitable business models ever created, while the average retail trader struggles to survive their first year? The answer lies in a single fundamental difference in operating philosophy. The casino does not care whether the next hand of blackjack wins or loses. The dealer does not panic, sweat, or doubt the game rules when a player hits a lucky streak. The casino knows that the outcome of any single hand is completely irrelevant. Across 10,000 hands, the mathematical edge built into every game will produce a predictable, consistent profit. The aggregate outcome is certain, even if the individual steps are pure.
Chaos. That is the entire operating philosophy of the most profitable business model ever invented. And it is the exact opposite of how most retail traders approach the market. Most traders approach every single trade as if it is the hand that determines everything, as if this specific entry, this specific setup, or this specific moment carries the full weight of whether trading is a viable path for them. They are emotionally attached to the outcome before the trade is even open. This intense attachment completely distorts every decision from the moment of entry to the moment of exit. Instead of a calm, consistent process that lets an edge accumulate, trading becomes a volatile, emotional roller coaster. Every win feels like personal validation. Every loss feels like personal failure. The trading account balance directly reflects that emotional volatility. It does not grow consistently. It swings, stagnates, and bleeds slowly through the accumulated cost of micro-decisions made under intense emotional attachment to individual outcomes. This video is about how to think like the casino, how to detach from the individual trade and attach to the process. Let us start with what the casino actually understands that most traders do not. The house does not have a massive advantage over the gambler. In fact, the edge in most casino games is tiny. Roulette with a single green zero gives the house an edge of roughly 2.7%. That means for every $100 wagered, the casino expects to keep about $2.70 on average. In isolation, that edge is embarrassingly small. But when you multiply it across millions of bets placed by thousands of players every single day, the result is a business generating hundreds of millions in profit every year, reliably and predictably. And here is the kicker. A sound trading strategy with a 60% win rate and a 1 to 1.5 risk-to-reward ratio has an edge that is vastly superior to any casino game. The math is genuinely favorable. More favorable than most offline business owners can ever claim. But that edge only shows up in your results if it is applied across enough trades, with absolute, uninterrupted consistency. 5 trades does not give probability time to work. 20 trades does not either. The noise in any small sample can make a winning strategy look completely broken, and make a losing strategy look brilliant. A series of consecutive losses isn't a sign of failure. It's simply daily statistical noise. 100 trades is where the picture starts to become clearer. 200 is better. 500 is where the edge of a sound trading strategy is unmistakable in the performance data. But getting to 500 trades on a consistent, unmodified strategy requires not caring about any single trade's outcome. Across 500 trades, there will be losing streaks and sideways periods. Each of these drawdown periods will generate enormous psychological pressure to change something. The casino does not change the blackjack rules during a bad night at the tables. It knows that bad nights are simply part of the distribution of outcomes that its edge produces. It changes nothing. It opens the doors again tomorrow, applying the exact same edge to the same games with the same rules. That mathematical equanimity is the exact psychological state a trader must develop. Not optimism, not blind confidence in your next entry, just the cold, calculated calmness of an operator who knows their edge is real, Their sample size is growing, and individual outcomes are completely irrelevant to the long-term result. Let's look at what attachment to individual outcomes actually does to execution in real time. When you care deeply about whether a specific trade wins, accepting a stop loss becomes emotionally unbearable. Accepting the loss feels like personal failure. So the stop loss gets moved just this once to give the trade a little more room. You convince yourself that your conviction in the setup justifies this extra space. But moving that stop loss instantly converts a predefined, managed loss into an undefined, potentially catastrophic one. The risk management that makes your strategy sustainable is overridden by your emotional need to be right on this single trade. When it fails anyway, the loss is massive, the account is severely damaged, and you are thrown into a cycle of searching for a magic indicator that does not exist. To break this cycle, stop operating like a desperate gambler searching for a hot streak. Commit to a defined edge and let the mathematical distribution of large numbers play out, and execute every trade with absolute mechanical indifference. Trust the architecture of your process. Now, stop playing the game and start owning the house.